What's going on? Steve here with IBC Global. In today's video, we are going to have some fun and go over step one of our process when individuals work with us, which is maximizing your cash value. And why individuals work with us, the reason why someone reaches out is always because they are interested in a whole life insurance policy and they want to make sure that it's set up right. They want maximum cash value, they want maximum flexibility, they want to know what different companies and products are available that would really fit them best. So the policy is, again, set up for maximum cash value, and then they can use the policy as time passes, whether that's for loans, income, and retirement. And why they're working with us is because we make it a point to help with that stuff, meaning the initial setup and then also working with individuals throughout the life of their policy. So with that said, let's get on into it and have some fun talking about cash value life insurance. What we're going to go over is an example of what we showed an individual interested in a policy where the goal was maximum cash value. So what we've got here is a 45-year-old individual interested in a whole life insurance policy. The cash value is the main reason why. What he is interested in with the cash value is the safety, liquidity, and tax benefits that come with the cash value. What he wants to fund the policy with, which is how much he wants to deposit. This is his cash going into the policy. Again, it's a life insurance policy, he gets life insurance, but the cash value is what he's interested in. The first year, a lump sum deposit of $300,000. After that, years 2 through 10, $100,000 per year. Now, we'll talk a little bit about the company selection and flexibility in a little bit. What I'll say is he is not committed or required to fund $100,000 every year. In fact, he could get away with just funding the $300K and never adding another penny after that. So my point of mentioning that is setting the policy up to be very flexible is important. So the options we showed him: one, products that give him more cash value long-term, and then products that give him more cash value upfront. We've seen these are options that people like to see upfront, meaning where we often see buyer's remorse or someone regret starting a whole life insurance policy is when they start a policy, they think that it's the best option possible because it's what they were shown after they discussed what they were interested in with an agent. Then they see or hear of a different option that provides significantly more cash value. And maybe it's just up front. Maybe it has less long term, but the individual looks at that and says, man, I wish I would have just seen that initially because the upfront cash value would have been really, really valuable because I value the fact that I can access money for real estate deals or for my business in the early years. The early cash value is important. Or the opposite could be true as well. So in this case, we showed both options, went over the pros and cons, and then let him pick the one that he's most interested in. And we also provided a recommendation, which I will tell you what that was at the end of this video. Company choice, or options, I should say. We looked at 2 of the 4 major mutual companies. We've got A, MassMutual, and then B, Guardian. With MassMutual, we specifically looked at their 10-pay policy because among MassMutual products, that does deliver the highest internal rate of return on cash value. Meaning, when you look at MassMutual products and look at the same dollar amount going into a policy, especially if it's 10 years or less, that 10-pay is going to produce some very strong results, the strongest among all other MassMutual products, at least at the date of shooting this video. If they make product changes in the future, things could change. They've changed before. Then we've got Guardian. We looked at their L95 policy, which is one of my favorite options available with them. We looked at 2 versions of that, one of which gives more cash value long-term, the other gives more upfront. We'll go through exactly that. Now, what I want to hit on here are some key differences with the flexibility. This part is so important and often helps people refine their decision-making process. So one, we see different minimum premiums here, or the minimum requirement. With Mass, we see it's about $34,000, whereas with Guardian, it's $13,000. That's a significant difference. The reason why we see such a difference there is because of this first year lump sum. He is paying a significantly larger amount of money into this policy in the first year compared to all future years. And why that's important is because when we set up a policy, all companies have different limits as far as where we can direct our money. It can go toward the insurance premium or toward our PUA rider. The name of the game is minimizing the premium and maximizing the PUA rider. MassMutual will allow us to wherever we set our premium, we can pay 10x that in PUAs. Whereas with Guardian, wherever we set our premium, what we can illustrate when we put these policies together is PUAs. We can illustrate 10x that. We do have to have the appropriate term riders attached and such. We've got other videos that go through that, but we can illustrate 10x that, except for the first year, where we can go up to 50 times that. So right there, we see that Guardian, just with their product rules, allow a much larger upfront lump sum payment than MassMutual in this particular case, which is why we have a lower premium requirement here. So that's one key difference. Another big difference is the flexibility. So with MassMutual, the total amount he pays in each year needs to be paid at the same time. So for example, let's say he does something like this. He starts off in year one with $300,000. Then in year two, he pays $100,000 as planned. But then in year three, he wants to slow down a little bit. Life happens. He says, you know what? I want to pay less into this policy in the third year. When year three rolls around, what we would need to do is adjust the total funding to the amount he'd like to pay. Say it's $50,000. If he wants to add more during year three, say 6 months in, he won't be able to. He might be able to, but he might have to go through medical underwriting, kind of a pain. In order to easily adjust the funding, we would want to wait until year four. Then at that point, you could scale it back up to 100. You could even go up to 150, make up for lost time, or go higher than that. You could actually go up to 300 per year. But the point is, one time per year is when he can make deposits, premium and PUA all at the same time. Whereas with Guardian, it is much, much different. All he has to do is commit to the $13,000 per year. He's billed for that. He could even break that up over 12 months if he wanted to. And then everything else, when he adds money to PUAs, which is again, how you maximize the cash value, he can do that by logging onto his online portal and just sending money in, or wire transfer, mailing in a check, doesn't matter. Very, very flexible. So there's some differences there when we look at the flexibility features. If I am comfortable and disciplined with a one-time per year payment, and that higher minimum premium doesn't bother me because I look at it and say, I'm always going to fund more than that anyway, and I'm still comfortable when I look at it, that's where MassMutual could work really, really well. Also, when we compare them right now, they do have a higher dividend at 6%, whereas whereas Guardian has a dividend at 5.75. I've got different thoughts and opinions on that because when we look at actual performance over time with whole life insurance policies, if a policy is set up right and it's with one of the 4 major mutual companies, Mass, Guardian, New York Life, or Northwestern, we've always seen strong results. Like it's hard to go with any company just because they have a higher dividend right now. That doesn't always mean they're going to have the most value long term. We haven't seen that to be consistent just when we study the history of whole life insurance. I hope that makes sense. But with that said, you will see stronger illustrated value long term with this because of the higher dividend. We've got differences in flexibility. You have some differences there. And that's the information right there that I want to be aware of when I am making a decision. How important is that flexibility to me? If I'm looking to take loans and such, I want to understand the loan features of each carrier, the fixed rates versus the variable rates. It's important information aside from just what the numbers look like that'll help me pick the option that is truly best for me. Let's look at what we showed him in terms of the different options. So again, We've got the different products here. In a case like this, we would provide the detailed illustrations as well, which is the full illustration packet from the insurance carrier. And we've got the simplified values here. A $300K lump sum, $100K per year thereafter through year 10, MassMutual and Guardian, beginning with MassMutual and their 10-pay product. What the 10-pay means is that it can pay the premium for a maximum of 10 years. What we see here in red, the minimum premium. And we had on the whiteboard base plus term. This is your base premium plus your term insurance rider. The purpose of a term rider is to raise the death benefit, which really prevents a MEC from occurring, which is a taxable event. Anyway, I won't get into all the details of that today. But we've got the minimum, PUA rider, total annual outlay. This is your net out of pocket each year, the annual outlay in blue. And then the total outlay tallies up all of your payments. So over 10 years, you would have paid in $1.2 million. What is highlighted in yellow represents your break-even point. This option provides strong upfront cash value and also strong long-term cash value. It's kind of a win-win there. He's close to a year 4 break-even when we look at it, and he's positive in year 5. Okay, then we mentioned the L95. We see 10% PUA fee and 5% PUA fee. The 10% PUA fee is designed for greater long-term potential in terms of cash value growth, and the 5% PUA fee is designed for more cash value up front. And also higher guaranteed cash values when we look at them. That is important to some people. So looking at this, where we can see the difference in upfront cash value versus long-term cash value, this one takes the biggest hit up front. You're at $265, whereas this is the most attractive up front. You're at $280. You paid in $300, and you got $280 right out of the gates. Just about there, year 3, as far as getting all your money back. So if we like recapturing our money quickly, this is a fantastic option there. If we look at it and say, hey, I don't think I'll need access to all of that, but I like Guardian, for example, then we might lean toward this option. And the 10-pay could be a fit as well. In his particular case, just as we discussed different options, the Guardian was very appealing because of the flexibility. He could commit to a low amount and add more discretion. The $100K per year should be easy for him, just per our conversations. But again, just from a peace of mind standpoint, knowing that I can be billed for $13,000 and then adding more discretion, it creates a situation where I see that and it causes no financial or emotional stress thinking, I've got to pay that every year. It's, hey, I can do that. I'll probably even add the full 100 upfront each year. But I know if anything happens, he owns a business. If you own a business, you know what that means. Cash flow can fluctuate. I can easily commit to that. Never feels like a burden, then add more discretion. That's the appeal there. And when we talked about the upfront cash value and compared the options, one of the things he did mention is that he didn't feel like he would need access to cash value in the early years. He likes it there in case an opportunity presents itself. But he did say, yeah, I do like the long-term option more, just because in the early years, I don't see myself accessing the cash value a whole lot. And I specifically asked him too, in the early years, do you see yourself wanting to use this for a real estate deal that becomes available? And his answer was no, probably not. And if a really attractive deal does come around, I've got other assets that I could use to acquire that. So with that said, and looking at the different options, he picked the one in the middle as we look at these options here. So I do hope that this was helpful. Let us know your thoughts and let us know which option you would prefer. If you have any questions, please leave them in the comments below. If you enjoyed the video, please hit the like button, subscribe for more, and as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.